What if the biggest financial heist in human history is happening right now, not in a dark alley, not on Wall Street, but in broad daylight, in the pages of government balance sheets most people will never read? And what if the architects of this heist aren't criminals? They're the people in charge. Today, we're pulling back the curtain on a plan so elegant, so mathematically precise, that the only reason it works is because almost nobody is paying attention. If you're the kind of person who wants to understand the game before the final whistle blows, you're in the right place. Welcome to FinHistorian. Let's talk about the $38 trillion magic trick. Start with the number itself, $38 trillion. The official U.S. national debt as of early 2026. It's a figure so absurd that our brains essentially refuse to process it. Here's a frame that might help. If you spent $1 million every single day, starting from the moment the Roman Empire was at its peak, you still wouldn't have spent $1 trillion by now. The United States owes 38 of those. And the interest payments alone, the bare minimum just to stay current, have now crossed $1 trillion per year. For the first time in American history, the government spends more servicing its past debts than it spends on its entire military. Every aircraft carrier, every nuclear submarine, every soldier's paycheck, outpaced by the interest bill on old borrowing. Now, here's the question every honest economist eventually has to answer. Can this ever actually be paid back? And the answer, if you strip away the political theater and look purely at the arithmetic, is no. Not in real terms. Not in today's dollars. The debt-to-GDP ratio is sitting above 120%. The country owes more than it produces in an entire year. So if full repayment is off the table, what are the options? History gives us three. You can default outright, which triggers immediate economic collapse and global chaos. You can impose brutal austerity, cutting everything from Social Security to defense while raising taxes dramatically, which is political suicide. Or you can choose the third option, the quiet one, the one every overstretched empire in history has eventually reached for. You don't default on the number, you default on the value. You make the debt disappear by making the dollar worth less slowly, deliberately, and almost invisibly. This process has a name. Economists call it financial repression. The mechanics are straightforward. The central bank keeps interest rates artificially low while inflation runs above those rates. Your savings account earns 1%. Real inflation is running at 5 or 6. The gap between those two numbers is the silent tax. You lose purchasing power every single year while the number in your account stays the same. It feels like treading water. You're actually sinking. And that gap, that stolen purchasing power, flows directly to the largest debtor in the system. The U.S. government. Because their fixed debt just got cheaper in real terms. It's a perfectly legal wealth transfer, and it has worked before. After World War II, U.S. debt exceeded 110% of GDP. The government didn't pay it down through discipline or sacrifice. They inflated it away over 2 decades of controlled financial repression. The people who held bonds, who trusted the system, who lent the government money, they got paid back in dollars that were worth a fraction of what they originally handed over. History doesn't call that a default. It rarely calls it anything at all. But here's where this cycle hits a wall. Financial repression only works as long as people don't notice. The moment the public realizes that holding dollars is like holding a melting ice cube, they run. They dump the currency and pour into anything tangible. Real estate, commodities. And when that panic reaches a tipping point, controlled inflation becomes uncontrolled inflation. The slow demolition becomes a collapse. Which means if you're running this strategy, you need an anchor. You need something credible waiting on the other side of the chaos, something the public will trust when the old system stops working. And this is where it gets genuinely fascinating. Because the United States, which publicly dismisses gold as an outdated relic with no place in modern finance, quietly holds 8,133 metric tons of it, the largest official gold reserve on the planet. More than Germany, Italy, and France combined. The vast majority sits in a vault in Kentucky with a 22-ton door. And here's the detail that should stop you cold. The official book value of that gold on the U.S. Treasury's balance sheet is $42.22 per ounce. That number hasn't been updated since the 1970s. The market price today is hovering around $3,000, which means the government is sitting on a reserve it carries at roughly 1/40th of its actual market value. This isn't an accounting oversight, it's a loaded weapon. Because when you need to rebuild a balance sheet after a currency crisis, you don't have to tax anyone, you don't have to cut any programs, you simply reprice the asset you already own. FDR did exactly this in 1934. After forcing Americans to surrender their gold at $20.67 an ounce, he repriced the government's holdings to $35 overnight. The balance sheet expanded dramatically. Private wealth was transferred to the public ledger. It was called monetary reform. And now, picture that same move, scaled to a $3,000 gold price, or $10,000, or $50,000 in a genuine crisis. The math produces trillions in new balance sheet capacity from an asset the government already possesses, without printing a single additional dollar, without raising a single tax. Now add the second piece, and this is where the modern twist enters the story. For most of the last decade, the U.S. government treated cryptocurrency like a problem to be eliminated. Regulatory crackdowns, coordinated banking pressure on crypto-friendly institutions, enforcement actions against exchanges. The message was consistent and aggressive: this is dangerous, this is for criminals, this will not be tolerated. And then, almost overnight, the posture flipped entirely. January 2025. A new executive order prohibits the development of a U.S. central bank digital currency. The SEC's enforcement approach to crypto reverses direction completely. And then, in March 2025, the announcement that rewrites the entire narrative: the United States establishes a strategic Bitcoin reserve. The same asset that regulators had spent years trying to suppress is now officially recognized alongside gold as a reserve holding. And the government didn't even have to buy it. Through years of seizing assets from criminal prosecutions, the Department of Justice had accumulated hundreds of thousands of Bitcoin. The Silk Road, the Bitfinex hack, subsequent enforcement actions. The U.S. government entered the digital asset space as its single largest known holder, not through deliberate investment, but through law enforcement. And now that inventory sits in a strategic reserve, protected, not liquidated. The parallel to gold is almost too clean to be coincidental. Both assets exist outside the debt-based monetary system. Neither can be printed into existence. Both have historically surged in value during periods of currency instability. And both are now sitting on the U.S. government's balance sheet, carried at values far below where they might trade in a genuine monetary reset. Here's how the mechanism actually functions in practice. The government runs the inflation engine. Purchasing power erodes. Savers panic and look for exits. Wall Street, conveniently, has already built the on-ramps. Gold ETFs. Bitcoin ETFs. Accessible, regulated, frictionless. Hundreds of billions in nervous capital floods these products. That demand drives prices upward. And the primary beneficiary of rising gold and Bitcoin prices isn't the retail investor who just bought in. It's the entity that was already holding the largest stash of both. Every dollar of panicked savings that pours into these assets from the public is, in a very real sense, doing the government's recapitalization work for it. The debt doesn't get paid back in the traditional sense. It gets rendered manageable by destroying the real value of the dollars it's denominated in, while simultaneously inflating the value of the real assets held against it. It's not default. It's not austerity. It's a controlled rebalancing that transfers wealth from currency holders to asset holders, with the government positioned as the largest asset holder in the system. And globally, this reading is not unique. Central banks across Europe, Asia, and the developing world have been accumulating gold at a pace not seen in decades. Multiple consecutive years of over 1,000 metric tons in net purchases. China has been consistently adding to its reserves while reducing its holdings of U.S. Treasury bonds. These are not speculative investors chasing returns. These are the stewards of national balance sheets who have read the same history books and drawn the same conclusions. The system as it stands is not sustainable in its current form. Everyone in a position of financial responsibility knows this. The question has never been whether it changes. The question has always been how it changes, and who is positioned when it does. That's what this is really about. Not politics, not left versus right. The people occupying those chairs are, in many ways, irrelevant to the structural forces at work. The math is the math. The debt is the debt. And the pattern that stretches from Weimar Germany to post-war America to every over-leveraged empire before them points in one direction. The currency weakens. Real assets strengthen. And the people holding real assets, when the dust settles, emerge in a fundamentally different position than the people who trusted the promise printed on the paper. If this gave you a new lens for reading what's happening around you, that's exactly what FinHistorian is here for. We strip away the noise and look at the patterns that actually drive history. If you haven't subscribed yet, now is a good time. Because the story we just told is still unfolding, and the next chapter is already in motion.